Okay, welcome to the video lectures on chapter 13, the last chapter before you finish your business plan. What do investors look for in financial statements? In chapter 12, you learn to prepare your financial statements. We learn to value the firm. You learn to understand the financial statements. And now the question is, if you give this to an investor who may want to buy your firm, well, what do they look for in financial statements? It's a very important and useful topic. But before we go for that, I posted another video. It's called Changing Education Paradigms. I'm just going to play a few seconds.
Every country on earth at the moment is reforming public education. There are two reasons for it. The first of them is economic. People are trying to work out, how do we educate our children to take their place in the economies of the 21st century? How do we do that, given that we can't anticipate what the economy will look like at the end of next week?
So, what I want you to do is watch this. It's only about 11 minutes. I've given you the link separately so the quality would be better. It's very important as you write your business plan, you kind of understand this. This video is done by Sir Kenneth Robinson. Many million people have watched this, and he is basically making the claim that how the traditional educational paradigms are kind of outdated and they need to change with the changing needs of the marketplace. So I want you to comment how you see that Accounting 201 has tried to change the way we teach accounting and to adapt to the needs of the marketplace and the needs of the students. And it's also good that you watch because it may give you clues for lessons learned under each chapter. So what I want you to do is, after you watch it, you in that extra credit 13 on comments on this video, you want to say that how you see what this video is calling for that Accounting 201 tried to adapt. And then what I will do is I'll read your comments and I will find those things that are really on the money to discuss in class or highlight in class. So just for watching the video and making a comment, you will get 1 extra credit. And if yours is chosen by me to highlight in class, you'll get 2 this week. Okay? So with that said, let's come back to chapter 13. What do investors look for in financial statements? 4 accounting concepts: comparing earnings, return on equity, DUPONT ratios, comparing ratios. Comparing earnings. Why do investors give their capital to companies? So the investors who read your financial statements are thinking of investing in your firms. Investing in your firms come down to giving capital to your firm. Why do they do that? Well, investors want companies to use their capital to earn more money. That's why we say earnings. Right? These earnings belongs to the owners and they have to be distributed back to owners sooner or later as dividends. Right? And we saw this in chapter 12. The owners cannot demand when it should be paid, when it's a corporation, but it's theirs and the corporation has to pay it back to them sooner or later. The portion of earnings that is not yet distributed back, and we saw how in the early years the corporation chose not to declare dividends until they pay off their liabilities. So the portion that is retained is called retained earnings. Now, why would a company retain earnings? To pay off debts, to grow the company, so you don't have to go out to borrow money. You can retain the owner's money and you can grow the company. What is the problem in comparing earnings reported by different companies, right? So if you come to our chapter 12, so if you come to the 5th year, so you see in the 5th year the net income after taxes, the earnings, right, is 69,744. Now what's wrong in comparing this with one of your earnings and say, well, our company seems to be doing better because it's making higher earnings than yours? Okay, the answer is companies that attracted more investment. So we can't just compare earnings. If some company attracted more investments, they should make more earnings, right? So you cannot say that because your earnings is lower than the sample business plan, somehow you are worse. In other words, a company that reports more earnings and investments may be performing worse than a company that reports less earnings and investments. Fewer amount is invested in them, so you're showing less earnings, but you may be performing better. So let's stop and think. So here's the question. Suppose the revenues and earnings of company ABC and XYZ is as follows. So sales, ABC is 100,000, XYZ is making more. Earnings, ABC is making only 20, XYZ is making 30. Which of the two companies' financial performance is superior? A. XYZ is superior because it has higher sales and higher earnings. Can we conclude that? ABC is superior because it has higher profitability of sales. If you divide earnings by sales, this is 20%, this is 15%, the profitability of sales. So you say ABC is better because it has higher profitability of sales. You can say, well, both are performing equally well. Fourth, not enough information to compare performance. Take a minute. The correct answer is D, because we don't know about the investments, that how much has been invested in ABC and XYZ. Okay, so let's go to second concept, return on equity. What is a better way to compare earnings of different companies? To make comparisons valid, investors divide earnings by their initial investment or equity. In other words, return on equity. How much did owners contribute initially, and then how much earnings did you make? So you divide the earnings by initial investment, and it's called return on equity. So return is the annualized earnings over an accounting period. Equity is the contributed capital plus retained earnings at the period beginning. ROE is stated in percentages to be comparable with interest rates and internal rate of return. So if you come to our year 5, so here is our earnings, right? And then we want to divide this by how much have the owners invested at the beginning of year 5. So when you come here, you go to the balance sheet, and if you go to the end of year 4 balance sheet, you see that owners, there is all of the funds are by owners. No creditors are funding anything, and owners 20,000 is their initial contribution, and 34,220 is their retained earnings. So what at the end of year 4 or beginning of year 5, owners have invested 54,220. So you really want to divide your earnings by that initial investment, which is kind of what we are doing in chapter 13. So here is that 69,744 annualized earnings, the 5th year earnings. Here is the beginning equity, the end of year 4 in the balance sheet. We found owners have invested 54,220. So if you divide this by that, you get 128.63%. So now if every company in the class takes their annualized earnings, divide by the beginning equity, then this percentage is comparable to see who is doing a better job. Okay. Now ROE is stated in percentages and to be comparable with interest rates and internal rate of return. And also note that when we talk about return, what do owners get in return? It's the earnings, but you annualize it. In our case, of course, the 5th year is already in a year. But suppose we did this for the whole 5 years, right? We wanted to find the ROE for the whole 5 years. So then you would see the earnings over the whole 5 years, right, is 219,608, right? But then if we are going to do ROE calculation for the 5 years, then we would divide this by 5 to annualize it. So when you come here, when we do this for the whole 5 years, that's what we are doing. We are taking the 5 years, dividing by 5 to annualize it, right? And then the initial equity is what you have at the beginning of the period, and that is contributed capital plus retained earnings. Unless you are doing it for all the 5 years, then at the very beginning it was only contributed capital because there was no retained earnings. Okay. And what is a good ROE in general? And here is a rule of thumb. If your return on equity is less than 10%, that's kind of a low performance, because you can kind of invest in a bank or a treasury bill and also make that kind of a return. Now if you're making more than 50%, like in our case 128%, that's a high performance. It's a good return on equity. Financial performance is good. And if it's between 10 and 50, it's average. Okay, let's stop and think about return on equity. What is the definition of ROE, of return on equity? Is it earnings divided by retained earnings, earnings divided by owner's equity, annualized earnings divided by owner's equity, annualized earnings divided by beginning owner's equity? Take a minute. Here the correct answer is D. So return on equity, return is the earnings, and equity is what owners have invested, but you annualize the earnings, and then it is the beginning owner's equity, right? And so the correct answer is D. Let's go to the third concept, DuPont ratios. How can investors gain more insights into the ROE number? See, sometimes they may look at our ROE 128%, okay, very high, to somebody else's ROE or even the previous year's ROE, and they want to gain more insights. Why is this different? So investors find it useful to break ROE into 3 ratios called DUPONT ratios. So remember, ROE is earnings, annualized earnings, divided by initial equity. Now, see, this is multiplication, this is multiplication. So what we have done here is moved earnings to the end. Initial equity is here, but then you multiply by initial assets and divide by initial assets. So they cancel. Similarly, multiply by sales, divide by sales. So really they are equivalent. This and this cancel, this and this cancel. So it's really earnings divided by initial equity. However, when you express it like this, say, okay, here is my ROE. What is this? This is my equity multiplier, right? Because your equity is multiplying, bringing more funds, and you may have assets worth more than the money that you contributed. So it's called equity multiplier. Then you have assets, and your sales, often you would like it to be much higher than the amount of money you have tied up. So this is called turnover, how many times your assets are turning over into sales. And then earnings divided by sales is profit margin. Well, how much of your sales is finally becoming earnings? So interestingly, you see ROE is the product of equity multiplier times turnover times profit margin. So if you come now to our ROE here, and this is what we have done now. So here is our annualized sales, right? And so if you come to chapter 12, here is our year 5 sales, so we have put that there. And then here is beginning assets. The beginning assets, it's again, you come to your balance sheet at the end of year 4, which is the beginning of year 5. You have your total assets of 54,220, and so now you can calculate the 3 ratios. So earnings divided by equity, we had 128. Now you divide earnings by sales, your profit margin is 26.57. Your sales divided by assets is your turnover 4.84. Your equity multiplier is just 1 at this point. So this 128.63% is 1 times 4.84 times 26.57, right? So let's come back here. So equity multiplier, EM, is a number greater than or equal to 1. Equity multiplier tells how much additional dollars each dollar of owner's equity has attracted. If your assets are more than the owner's equity, like if you come here, now the end of 4th year, you find your assets are the same as owner's equity because there is no liability. But when you come to the 1st year, you have assets worth of 108,867, but your owner's equity is actually negative. Or even if you come to the 2nd year, right, the beginning of the 3rd year or end of 2nd year, your assets are 100,216, right, but your owner's equity at that point is 32,883. So you can see you have way more assets than what owners contributed. Why is that? Because you borrowed, right? So coming back here, or if we come here to chapter 13, so here I have my equity multiplier is 1 because all of the assets I have has been financed by owner's equity. Okay. So, but if equity multiplier is greater than 2, if equity multiplier is 1 means there is no leverage, no financial leverage. But if it's more than 2, for every dollar of equity, you have gone ahead and borrow more than $1 to have more assets. So that's kind of high leverage. For $1 of owner's money, you have gone and borrowed more than $1. If it's between 1 and 2, equity multiplier is between 1 and 2, it's average leverage. So in our case, when we come to year 5, you see that's kind of average leverage. But whereas if we did this for the 5 years, right, our startup cost was 138,800, but we put only 20,000. So this financial leverage or equity multiplier is very high. That's one reason the ROE over the 5 years is very high. Okay, let's now come to T or turnover. This can be greater or smaller than 1. EM is greater than or equal to 1. Turnover tells how much sales the investment in assets has brought about. So it is talking about the productivity of assets. If turnover is less than 1, that's low productivity because you're not even generating sales equivalent to your assets. But if turnover is more than 2, that means your assets are turning over more than 2 times. That's good. If it's between 1 and 2, it's average turnover. So when we come to the 5 years, if you look at the turnover, right, we have 54,220 in assets, but the sales are more than 4 times. So this turnover is pretty good, way higher than 2. So it's a high productivity of your assets, and that's contributing to this high ROE. But if you come over the 5 years, right, and if you see your average sales is 246, there the turnover is low. So what was making this so profitable was the financial leverage, equity multiplier. Okay, and then we come to the profit margin, which is always less than 1 or less than 100%. It's stated in terms of percentage. So profit margin tells how much profits the sales generated by the firm has brought about. So it's really talking about profitability of sales. So if the profitability of sales is less than 10%, that's kind of low profit margin, low profitability. More than 20% high, between 10 and 20 is average. So when you come to our situation, you see that in our 5th year, our earnings divided by sales is 26.57. So that is high profit margin, right? And whereas if you look at over the 5 years, when you divide earnings by the annualized sales, that's kind of average, right? So here we had average profit margin, average turnover, but very high equity multiplier, financial leverage, that explains a very high ROE. Whereas in the 5th year, we have a high profit margin, high turnover, but low financial leverage. This explains this. Okay, let's stop and think. What is not true about EM? EM is equity multiplier. Investors like to see a higher equity multiplier. Increases in equity multiplier increases both the ROE and credit risk. Banks like to see a higher equity multiplier. What is not true? Take a minute. The correct answer is D, because A is correct. EM is equity multiplier. Investors like to see a higher equity multiplier, higher turnover, higher profit margin, because all of them drives the ROE up. Now, increases in equity multiplier increases the ROE but also the credit risk, because as EM increases, you're borrowing more and more. So the credit risk is high. You may be unable to pay the interest and you could be forced to declare bankruptcy. So that is correct. Now, banks like to see a higher equity multiplier? No. Because banks, when one bank has to give you a loan and they find your equity multiplier is already pretty high, that means you have already borrowed a lot. So tomorrow if anything happens, those guys who gave you money first have the first claims on your assets. So banks like to see a low equity multiplier. Okay, so that is the thing that is not true. Okay, now comparing ratios, right? How do financial analysts use ROE and DuPont ratios to study trends? They compare ROE over time to evaluate trends in financial performance of a firm. So they look at the ROE of the 4th year, 5th year, 3rd year, and they see, hey, is it improving? Is it decreasing? Is it going upward or downward? They compare the DuPont ratios to understand the reasons for the trend. What's causing it? Is it the financial leverage? Is it the productivity of assets? Or is it the profitability of the sales? So sometimes different things may be happening. So how do financial analysts use ROE and DuPont ratios to analyze relative performance of a firm? They compare ROE with that of competitors to evaluate the financial performance of a firm relative to their competitor or industry average, right? So for example, here in chapter 13, we compare our performance to the last year of Nike. So their ROE is 15.58%. So that's kind of an average ROE. And so this is average and ours is high, and so compared to somebody else in the industry, we are doing a lot better. And then the analyst would want to know, well, what explains it? So here you have our EM, TO, PM. This is Nike's EM, TO, PM. So we can see, well, Nike has a higher financial leverage, right? And that should have made this higher, but this is lower. That's because their turnover is average, whereas our turnover is higher. And here you find their profit margin is very low, right? And ours is high. So you can see they got one thing going for them. Financial leverage is high, but these two are lower than ours. So finally their performance is significantly lower. So that's what we are saying here. They compare ROE of the company with that of competitors, and they use the DuPont ratios to understand the reasons. Is it financial leverage, EM? Is it productivity of assets, TO, or profitability of sales? If the beginning equity, let's see, if the beginning equity of companies XYZ and ABC are the same, so it's the same amount of equity, but the ROE of company XYZ is higher, then which of the following statements have to be true? So remember, ROE is earnings, annualized earnings, divided by beginning equity. So if the beginning equity are the same, and if ROE of XYZ is higher, well, which of these has to be true? Assets of XYZ are higher. Sales of XYZ are higher. Earnings of XYZ are higher. None of the above. The correct answer is C, because that's the only thing we can say for sure, because ROE by definition is annualized earnings divided by beginning equity. If the beginning equity are the same, if ROE of XYZ is higher, then that means earnings of XYZ are higher. We cannot tell about assets and sales, because you could have had a higher equity multiplier, right, but then a lower turnover, or vice versa. So the correct answer that we can say for sure is C. Okay, so I will do the video tutorial and go over the notes, and also I will review the executive summary, and hope this